Welcome back to the Deep Dive. Today, we're digging deep into Welspun Specialty Solutions Limited, or WSSL. We've got the Q2 and H1 results for fiscal 26, their investor deck, and, all the juicy details from the earnings call.
Right. And our focus really is tracing how a big player, an integrated specialty steel manufacturer, is navigating some, well, pretty choppy global waters, high volatility protectionism while pulling off a major financial turnaround.
Yeah, and the sources, they paint a really clear picture. It's not just about tightening the belt. It feels like a decisive strategic pivot.
Definitely. Leveraging that domestic Make in India push seems critical and honing in on those higher value products.
Exactly, and the proof's in the pudding, right? Hitting an all-time high for pipe volume in Q2. That's pretty remarkable given the backdrop.
It really highlights the resilience, of the Indian domestic market currently, and maybe the agility of WSSL's management, adjusting course quickly to catch those local wins.
So this deep dive, it's about connecting the dots. Strategy on the factory floor, right back to balance sheet numbers.
Precisely.
Okay, let's jump straight into those financials then, because the turnaround is, well, it's quite stark. We're seeing a real shift from loss to profit. Looking at the top line, revenue for Q2 FY26 hit INR 2,427 million. That's up 40% year over year and 15% just from the previous quarter.
But here's the interesting bit, the efficiency story. Their EBITDA, that's earnings before interest, taxes, depreciation, amortization, INR 181 million for Q2.
Okay.
That's a 117% jump compared to last year. And what the sources really hammer home is that this EBITDA growth way outpaced the revenue growth.
Right. So revenue up 40%, but EBITDA up 117%. That big gap screams operating leverage. Can you unpack that a little for us?
Sure. Operating leverage basically means their fixed costs. Think factory rent, core staff, maintenance. These are staying relatively flat while their output, their volume is ramping up.
Okay.
So they're sweating those existing assets harder, getting more efficient. A bigger chunk of each new rupee earned falls straight to the profit line instead of getting eaten by rising costs.
And that leverage, it fundamentally flipped the script on the bottom line, didn't it? Profit after tax, PFT pay, for Q2, INR 96 million.
Compared to what? An INR 64 million loss the year before, Q2 FY25. It's a huge swing.
Yeah.
And, for a clearer view on actual financial health, you look at cash generation. The first half, cash payday, stripping out non-cash stuff like depreciation to see the real money generated, that figure, grew 4.7 times over H1 FY25.
Wow, 4.7x.
Yeah, it shows management's focus isn't just on paper profit, but on generating and holding on to actual cash. Liquidity.
That definitely shows momentum. But, financial health isn't just one quarter. It's about stability, credibility for the long term.
True. And two things back that up. First, the order book looks solid. End of Q2, volume was near 6,000 metric tons.
Okay.
Valued around INR 2,540 million, so 254 crores. That gives them visibility, helps planning.
Right. Near-term revenue locked in.
Exactly. And second, their credit rating got an upgrade from CARE. Long-term facility moved up to CARE from A+ LEP.
Hang on. A+ to AA. In this kind of volatile specialty steel market. That's a pretty big vote of confidence, isn't it?
It really is.
Did the sources say what CARE pointed to specifically? Is there one single biggest factor?
It seems to be a combination. The rating agency reflected that external confidence boost, mainly driven by, well, two things. That proven financial discipline we just talked about, and the successful pivot to domestic strength.
Okay.
The solid order book, the clear path to using their capacity better. It signals something sustainable, not just a flash in the pan.
That tees up the next section perfectly.
Yeah.
Moving from the balance sheet to the shop floor. Because operational success clearly enabled this financial picture. What were the big production milestones?
Well, after some planned maintenance earlier in the year, their pipes volume really snapped back, actually achieved an all-time high quarterly sales volume in Q2.
All-time high. So they're not just making money on paper, they're physically moving record amounts of product.
Correct. And it wasn't just pipes doing the heavy lifting either. No. In the first half, H1 FY26, their bars sales volume shot up 67% compared to the first half of last year.
67%. Wow.
So they're clearly finding ways to utilize their existing lines better across different products. Plus, they're pushing hard on market penetration, added 21 new customers in H1.
That's crucial diversification, isn't it? Especially if your traditional export markets are getting tougher.
Absolutely essential. And speaking of optimized production, they also made some frankly, impressive strides on the sustainability front.
Oh, so.
Their use of renewable electricity jumped significantly. It went from about 31% in the last full fiscal year to roughly 50% just in the first half of this year, H1 FY26.
Okay, 50% renewable power. That must impact their carbon footprint
And probably costs too.
directly. And they quantified the pollution impact.
Yeah.
Their emission intensity, basically, CO2 equivalent per ton of steel produced, dropped quite a bit.
Do we have the numbers?
Yeah, it went from 1.06 tons of CO2 equivalent per metric ton down to 0.72.
That's a noticeable drop. It is. That metric, T.CO2 it's the standard way the industry tracks greenhouse gases relative to output. A drop that's sharp suggests more than just flipping a switch on power source. It points to optimized production using those cleaner sources efficiently.
Okay, so let's dig into the structure that allows WSSL this kind of efficiency and quality control. It really comes down to their integrated model, right?
Yes, that's their big competitive edge, according to the sources. WSSL is apparently the only fully integrated specialty steel facility in India.
The only one.
That's what they state. Think of it like they control the whole process, from melting the steel right through to the finished pipes and tubes, all under one roof on a 126-acre site.
Why is that vertical integration so important right now, especially for specialty steel?
Well, when global supply chains are shaky or you've got tariffs popping up, that control gives huge advantages. Cost certainty, much better quality control, quicker time to market.
Makes sense.
And their product list rolled bars, heat-treated bars, seamless pipes, heat exchanger tubes, U-bend tubes. These need absolute precision. That integrated setup helps guarantee it.
And they still have a global footprint, despite the export drop.
Yeah, they maintain market presence in key regions like the U.S., Germany, Italy, South Africa, alongside India, obviously.
Okay, this is where it gets really interesting for me. Their forward strategy isn't just make more stuff. It's about strategic investment to increase the value of what they make. CapEx focused on the future mix.
Exactly. That new Bright Bar project construction's apparently going full tilt, scheduled to commission in Q3 FY26. That's the cornerstone of this value-add plan.
Let's be clear on this, though, because capacity investments can be tricky. This project, it doesn't mean they can melt more raw steel or make more basic pipes, does it?
No, and management was very clear on that. This specific investment does not add core steel or pipe making capacity. What it does do is dramatically boost their ability to take that steel and finish it into higher margin bright bars.
Okay, so what's the scale of that boost?
Current bright bar capacity is around 30,000 tons a year. This new shop will push that up to maybe 70,000, 75,000 tons a year, almost tripling it. It's a very targeted move towards those better value items, higher margin.
And alongside that, they're working on getting the right paperwork, the compliance needed for those strategic domestic sectors, the IBR accreditation for alloy steel bars and tubes.
Right. IBR Indian boiler regulations, that's crucial. It's a certification you absolutely need for products going into critical applications. Think power plants, specialized refineries, high pressure stuff.
So getting that certification, expected in Q3 FY26, unlocks new high-spec domestic markets.
Exactly. It's a ticket to play in those high specification, often higher margin domestic projects.
So the management priority seems clear. Use what you have more efficiently, but make sure what you're selling is increasingly valuable. What's their target for overall plant utilization?
Yeah, the thinking is sound. Focus on sweating the existing assets before pouring cash into major expansion. They seem confident they can achieve a 25–30% volume improvement year over year.
25 to 30% volume growth. That's ambitious.
It is, and they see 85% capacity utilization as the optimum, kind of the sustainable sweet spot for this type of integrated operation. They believe that's doable within about 3 years.
Aiming for 80–85% utilization.
Yeah.
That level of confidence is pretty striking, especially when you consider the global storm clouds.
Which brings us to Section 4. Navigating those big external headwinds.
Absolutely. And the global pressures are real. Demand is subdued overall. There's heightened volatility, especially after recent U.S. tariff actions on steel.
Right.
And just general uncertainty from geopolitical tensions. That always makes companies cautious about spending, hits consumption in key export markets.
And the impact on WSSL's own export business was, well, pretty severe, wasn't it?
Painful is probably the right word. The
Okay.
sources detail that the company's overall steel export mix just plummeted. It went from maybe 35–40% of their business last year down to only 15–20% in the first half of this year.
Wow, cut in half.
Pretty much. And pipe exports saw a similar proportional drop from 15–20% down to less than 10%. Ouch. Yeah. And one executive mentioned the price pressure is fierce, particularly on the bar side. They're having to fight hard against local mills globally. But, interestingly, management also stated they feel current pricing levels look like they might be the bottom.
Okay, so they think maybe the worst of the pricing pain is over and volume is starting to compensate. But still, that sharp drop in exports, it makes that 25–30% overall volume growth target seem, well, challenging. Where's that growth actually coming from?
That is the crucial question. And the answer seems to be the surprising strength of the domestic Indian market.
Right.
India's real GDP grew 7.8% in Q1 fiscal 26, and the Reserve Bank of India actually revised its full-year forecast up to 6.8%. The domestic economy is consuming materials.
And which specific sectors are really pulling that demand for high-spec stuff like WSSL makes, stainless pipes, bars?
It's that alignment with Make in India, combined with big investments in strategic areas. You've got energy, defense, space, oil and gas, petrochemicals, major public infrastructure projects.
All these require high-quality stainless steel products. That's the domestic tailwind WSSL is riding. Their strategy has very clearly shifted focus primarily to India, while staying ready for exports to eventually recover.
Okay, so wrapping this up, what does this all mean for you, the listener? We started this deep dive looking at a company facing some serious global challenges, but managing a financial turnaround.
Yeah, the key takeaway, I think, is that WSSL didn't just weather the storm, they actually thrived in a way. They pulled off this major financial turnaround, flipping that loss into profit, hitting record sales volume.
Despite the export collapse.
Right, by really leaning into their unique integrated structure, that only in India capability, and by strategically pivoting hard towards domestic demand for higher value products, that new bright bar capacity, the IBR certification, it's all part of that focused domestic play.
A classic case, really, of strategy meeting execution, resulting in record volumes even when a big chunk of their market evaporated.
And maybe here's a final thought, something provocative for you to mull over. Management sounds confident pricing is near the bottom. They expect volume to grow 25–30% year over year, thanks to those domestic tailwinds.
Yeah.
But volume growth alone doesn't guarantee fat margins.
Right.
So the question is, how quickly will that demand from those strategic domestic sectors, energy, defense, infra, translate into a really significant margin recovery, enough to let them fully cash in on that new bright bar capacity and hit those 80–85% utilization goals, that margin story.
Oh, yeah.
And that's the knowledge gap to watch closely going forward.
That's a great point to end on. Thanks for diving deep with us today.
My pleasure. Until next time.